Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get started. This is the U.S. market analysis for April 7th, 2026.
This video presents a direct informational narration of the source document.
So here's our agenda for today. We'll start with Section 1, the disclosures and important notices. Then we'll dive into Section 2, the geopolitical shock variables that are moving the market. After that, in Section 3, we'll look at the immediate asset price reaction. Next up is Section 4, where we'll explore some S&P 500 opening scenarios. Then we'll get into the market microstructure analysis in Section 5. And we'll wrap it all up with Section 6, the risk outlook and conclusion.
Okay, first things first, let's cover the important notices.
So just a quick but really important note. This document is intended for informational and research purposes only. It absolutely does not constitute investment advice. And as always, investing involves significant risk, and past performance is not indicative of future results.
And to be perfectly clear, this document is not financial advice, and no advisory relationship of any kind is created. Readers are solely responsible for their own investment decisions and must conduct their own independent research.
All right, with that covered, let's get to the core of it. Section 2, Geopolitical Shock Variables. So what happened? Well, after the close on April 7th, 2026, we saw a really sharp compression in the geopolitical risk premium. This came right after the Trump administration extended the deadline for military action against Iran.
You've got some really complex multi-party dynamics here. The US and Israel have paused bombing, while Iran coordinates safe passage. But this is all happening amid complete distrust. Now, that complete distrust is really the source of the fragility here. It reflects a historical fear of asymmetric surprise attacks. So the key strategic assessment is this: the market rebound is just a liquidity repair. It is not a strategic turning point. That's a critical distinction.
Okay, so how did all of this actually hit the markets? Let's move on to Section 3, the immediate asset price reaction.
This marginal improvement in the geopolitical backdrop, well, it allowed price action to completely reprice that headline risk premium. And it happened within an extremely short liquidity window, just incredibly fast.
If you look at the energy markets, WTI crude is now testing a key support band. We're talking a low of $90 and a high of $96 per barrel. That's the zone to watch.
On the equity side, S&P 500 futures saw a jump of about 50 to 60 basis points. The speed of this move was driven entirely by algorithmic systems that process the news in minutes.
So what does this mean strategically? Well, that sharp decline in energy prices has effectively created an entry permit for CTA systems. But, and this is a big but, the positive headline seems to be largely priced in already. This presents a really unfavorable risk-reward profile for any late entries.
Okay, that brings us to Section 4, S&P 500 opening scenarios. Let's game out what could happen next.
All right, let's break this table down. There are three main scenarios. First, Scenario 1. If the market opens above 67.50, you're looking at a strong long or even a short squeeze. The logic there is that CTA buying and short covering would reinforce an aggressive move to the upside, targeting 68.65 to 6900. Now, Scenario 2, which is between 67.30 and 67.50, is more of a technical tug of war. Here, the focus shifts to whether traders maintain or remove protective hedges, and you could see intraday volatility widen. And then there's Scenario 3, an open below 67.30. That's a weak, choppy zone. It would suggest there isn't enough CTA participation, and you'd likely see the gap up fade as long confidence deteriorates.
So, the key takeaway here is pretty clear. A stable hold at these higher levels is the prerequisite for preserving market confidence. A failure to hold 67.50, well, that would suggest the market remains very skeptical.
Let's dig a little deeper now. On to Section 5, Market Microstructure Analysis.
So what's really driving this move? At its core, it's a collapse of the short-side defensive line. The confirmation for this is coming from leadership in both the Russell 2000 and NASDAQ futures. And here's a sentiment indicator. A trader's loss of composure signals that the pain threshold for short sellers has been reached. All this is happening against a fundamental backdrop where S&P 500 EPS growth, importantly, has not substantively deteriorated.
Okay, let's bring it all home with our final section. Section 6, Risk Outlook and Conclusion.
And here's a really interesting quote from the analysis.
The market is highly likely to enter a geopolitical garbage time window over the next 2 weeks. It's a striking way to frame the current environment.
So, what are the risks inside the so-called garbage time window? Well, there are 3 key things to watch. First, there are gaps in the agreement terms that are basically red lines for the US and Israel. Second, there's a serious execution slippage risk with tanker flows in the Strait of Hormuz. And third, this all overlaps with a really dense earnings reporting window that's coming up in just 15 days.
The document sums it up with a pretty stark analogy. I'll quote it directly. The current market state is akin to Russian roulette. The bullet remains in the chamber, but the trigger point has not yet been reached. It's a powerful way of saying that this ceasefire is not a state of peace.
So what's the ultimate dividing line? What separates this headline-driven repair from a genuine fundamental reversal? It all comes down to one core technical benchmark for the S&P 500 cash index, 6980. That is the number to watch.